Well, hello, everyone, and welcome to our weekly 20-minute webinar. I'm Jim McCormick, Global Head of Desk Strategy at NatWest Markets, and joining me, as always, are our co-heads of Global Economics, Michelle, Girard, and Ross Walker. In terms of today's agenda, Ross is going to talk about next week's what looks to be fairly interesting Bank of England meeting. Michelle's going to review this week's data and FOMC meeting from last night. She's also going to look ahead into next week's fairly busy calendar and also give us some interesting thoughts on the long-term outlook for inflation. I will end, as always, with a few market themes, and then, as always, we will have Q&A afterwards. So please text us any questions during the call or use the raise hand function during the Q&A session. And with that, I'll hand it over to Ross.
Well, thank you, Jim. Yes, Bank of England policy decision and quarterly monetary policy report next Thursday. Although we don't expect any change in policy settings, this is nevertheless a key meeting and a great opportunity, an important opportunity for the Bank of England to shape guidance around where policy goes over the remainder of the year. The BOE has obviously done a huge amount so far, probably the busiest month in their 325-year history. We've had rate cuts, we've had quantitative easing, countercyclical capital buffers being cut, lending support mechanisms being restarted and altered. So probably policy-wise, a quieter month. But I think the key thing is going to be, firstly, what we'll get that's new. For the first time, the Bank of England will publish post-crisis macroeconomic forecasts. So we'll have an official UK GDP estimate. On this, I think the bank probably errs on the side of pessimism. The consensus that seems to be forming around UK GDP is that we will get something like a 6.5–7% decline in 2020. That's the IMF forecast. The Bloomberg consensus is around 5.5–6% fall. So for me, for the bank, given everything they've done in terms of policy action, it would seem to be to take a risk to have the market unwind some of that on the back of rhetoric or guidance that was judged to be insufficiently dovish. So one way of communicating a more dovish policy signal would be to have a slightly more pessimistic GDP forecast. And in any case, the data we've seen elsewhere in the world for Q1, US, some European countries, we're seeing slightly larger falls in GDP than were perhaps expected a month or so ago. So first key signal could be a weaker growth outlook and therefore preparedness to do more QE later in the year. How much could that be? Well, we think maybe another 200 billion, probably in two 100 billion pound clips. June, I think, is the obvious time to announce further purchases. At the May meeting next week, the bank will only be about halfway through its first round of 200 billion pounds of purchases. So nothing really to force them to announce anything next week. Similarly, gilt yields are low and look firmly anchored. Markets seem to be functioning in an orderly way. At the same time, we also have a huge amount of public sector borrowing and gilt issuance. So the BOE is also incentivized to do something to announce further QE, we think, sooner rather than later. So for us, the June policy meeting, the next meeting after next week's, rather than the next quarterly forecast round in August, seems more likely. And then we may get a final, let's say, 100 billion pound QE clip towards the end of this year. Bear in mind as well, we have the Brexit deadline probably looming at that point at the end of the year. So it's possible that the economy might need just a little bit more of a policy spur at that point. But on that note, let me pass over to Michelle in the US.
Thank you, Ross. So we had a bunch of developments this week. I'll dismiss those in relatively short order. I'll start with the Federal Reserve. And the fact of the matter is, with the Fed and other central banks willing to take action at any time, the import of a meeting on a particular day is much reduced. Nobody expected the Fed to take additional action this week. And in fact, we saw no new announcements in terms of facilities, no formal changing or shifting in terms of the structure of their quantitative easing program. The main message was first of all, that the Fed is quite concerned about the outlook, and more importantly, that the Fed stands ready to do whatever it is in its authority to do to provide support for the economy. On the data front, we obviously had a number of economic releases, including first quarter GDP, which showed a contraction of 4.8%. I will say personally, my takeaway from a lot of the data we had this week is that while the news is certainly bad, it perhaps suggests that the risk going forward in terms of the contraction that we're likely to see in near-term data in terms of the economy in the second quarter may not be as bad as some of the worst case scenarios that are out there. And what I mean by that is, for example, first quarter GDP at least gives us some marker of what the impact on the economy was from having a month or 2 weeks even of a shutdown in the economy. The estimates for Q1 GDP ranged anywhere from flat to minus 15%. Our own estimate was closer to the actual number of down 4.8%. So it at least, by not seeing a huge negative surprise of being wildly surprised by the magnitude of the hit in Q1, it does make me feel more confident that our estimate for growth in the second quarter to contract, say, down 30 or 35% may not be all that far off the mark. I mean, again, we've said all along, conviction of any forecast at this time is relatively low, and declines of 50, 60% plus, couldn't necessarily be ruled out. Some of the news that we're seeing suggests those worst case scenarios may not be as high a risk as we had feared. Another example would be the initial claims data. The data that we've seen confirm we've got a peak in the number of new filers, and more importantly, looking at the number of people that are actually receiving unemployment benefits suggests that the increase in the number of people unemployed between mid-March and mid-April is closer to 16 million than the 30 million number or 24 million, I should say, number of new filers for unemployment benefits that have been reported over that same 4-week period, meaning some people who filed for benefits have perhaps found other employment. And as I look ahead to next jobs numbers in the U.S., where we've got declines in payrolls of millions upon millions forecast, we had come into the week thinking the decline in payrolls could be maybe 24 million. These numbers suggest maybe you're looking at a decline of only 16 to 20 million. I understand saying a decline of only 16 to 20 million. That's a relief. And these are horrific numbers. But my takeaway from all the news this week is that some of the much, much worst case scenarios that people have talked about may not be as much of a risk. I do want to shift quickly to the inflation discussion that Jim had mentioned. There's been a lot of discussion, I will say, around M2 growth. I've had a number of people pointing out that M2 growth has been exploding. And the fact of the matter is that is really simply a reflection of the fact that central banks are across the globe blowing out their balance sheets as they're engaging in quantitative easing. The implication of this expansion in money supply in terms of what it means for inflation or growth, it ultimately will depend on how that money is put to work. It goes back to that old equation we learned in economics. MV equals PY. Money supply times money velocity is ultimately equal to prices and output. It's how that money ends up working through the economy that ultimately matters. Now, if we can post the chart or put up the chart, Dave, if you will. This chart shows the relationship between money velocity and inflation. And you can see, and there's a lead here, looking at money velocity with a lead time of about 1.5 years. In the wake of the global financial crisis, we saw a similar increase in central bank balance sheets. And as I've admitted, I initially thought you'd see as a result of that higher inflation. It didn't come to pass. And one of the reasons it didn't come to past was that money velocity collapsed. The money was put out there, but businesses and consumers didn't put it to work in the most basic sense. And you can see we're seeing the same kind of situation now. Money velocity has fallen sharply. And you've got people, well, you've got a handful of people or a number of people on one hand saying that the increase in money supply is going to be inflationary. Others are arguing this collapse in velocity will mean that once again, we're going to see downward pressure and almost disinflation or deflationary risk as the greater concern. Now, in our view, there's no question, as we've talked about, that near term, the demand side hit from COVID is going to put downward pressure on inflation. But when you think longer term about ultimately the impact on inflation of recent policy responses, it's going to depend very much on what money velocity does. And so rather than just looking at money supply, we keep urging people to be looking at indicators of velocity, to be looking in the months ahead at bank lending statistics, for example, at investment measures. I mean, the evidence of how the money is actually finding its way into the economy, which would then suggest what money velocity will be doing, are going to be far more important to be considering when we're trying to look at ultimately the implications of this monetary policy response. Thank you, Dave. We could take the slide down. I'll just end also by highlighting a piece that Giles Gale had written out of our group around the tail risk, if you will, associated with inflation because of actions that have been taken. And again, it speaks to the fact that near term, we are going to see a demand side hit that will put downward pressure on prices. But over the longer term, the supply side shock could ultimately be more long lasting. That is, we're seeing companies begin to cut capacity. They will certainly now are curtailing investment as, to reflect what could be a longer term structural shift on the demand side. But of course, as economies reopen and slowly consumers get more comfortable in re-engaging in activities, you will see demand pick back up. And you could very easily look ahead 2 to 3 years and envision a scenario where demand has normalized and to some extent a new normal, but yet capacity and supply has been reduced, and it takes a lot longer to bring supply back up than it does perhaps to bring demand. We could be looking at a situation over the longer term where inflation pressures are actually building because the supply side shock to the negative has proven to be more long lasting than the demand side shock. And so I do think that we've seen a number of reasons in terms of expecting velocity to rebound, as well as the longer term interplay between supply and demand that leave us concerned about over the longer term, the ultimate impacts of inflation moving higher and this not being a repeat of the post-global financial crisis period. And with that, I'll stop and turn it back to Jim.
Well, thanks. As always, I'm going to switch to markets. And let's just start by saying, up until today, at least, it's been a pretty good week for the main markets, with the S&P yesterday flirting with the highest level that we've seen since early March, although it is early days. It's only Thursday, and today's not off to a very good start. Now, that this positive sentiment continues despite some pretty grim growth data, I think tells you two things. Firstly, markets are beginning to look ahead toward the recovery, which is probably going to begin in March, at least at some level. And when you're thinking about the recovery, I continue to think that China's data continue to provide a loose blueprint in terms of where things may be heading for the rest of the world. So we got the April PMI numbers out overnight in China, and I'd say they were pretty encouraging. So you look at them, and China's domestic economy continues to improve pretty clearly. Services are up, construction was quite strong, manufacturing stable, and the weak point, I think unsurprisingly, given the shutdowns everywhere else, was in the export sector. And it's not clear that the rest of the world will be able to bounce with the same magnitude as China over the next couple of months, and that's certainly our worry. But certainly the mix of the recovery looks pretty sensible. It's also pretty clear that markets are enjoying the benefits of the huge monetary and fiscal response to this crisis. And on that front, I think, interestingly, the main message this week is that the hard policy work is now pretty much done. So the Fed didn't really make any adjustments. The ECB made only a small adjustment to its TRO program. The Riksbank resisted a move back into negative rates. And the BOJ, as we thought last Friday, desperately tried to make no policy change look like it was a very big policy change. And that's kind of the world that we're in. Now, looking ahead, tomorrow begins the fifth calendar month of this crisis, if you can actually believe that. And focus is, I think, again, going to change in pretty important ways. So it's probably worth going through and reviewing how we've evolved so far. So you go back to January. January was the COVID-19 was very much a China-specific issue. Didn't even have a name back then. And for most of the world, you really couldn't call it a crisis. And then February, you had the China lockdown, and then we saw early signs of the virus spreading elsewhere. March was the full globalization of the crisis, and I think the real inflection point in terms of the policy response. April was the economic shock, and this month was probably the worst month for global growth since World War II. I'm willing to bet on that. Now, May, the focus really shifts very quickly to the recovery with some very big questions. How quickly do economies open up? What does the opening up look like? How do individuals respond to the opening? Do we get second waves, and what does that mean? And of course, do we get any medical breakthroughs? One of the reasons why we had a bounce in stocks yesterday was some good news on an antiviral treatment. So May is clearly going to be another fascinating month. Now, in terms of themes, I just want to go over four quick things. And the first two are really a deeper dive into what Michelle's been saying about the banking system and inflation. So it's a really interesting point for banks. And one thing that I've said throughout this crisis is that it's underappreciated the health that banks had coming into this crisis. Really, in the past two crises, so the 2008 financial crisis and the Eurozone debt crisis, banks were a very big part of the problem. They were undercapitalized and heavily exposed. And after the crisis, there were big blockages to the recovery because they needed to recapitalize. This time around, banks are much healthier, much better capitalized. And as important, and you see this week by week, policymakers recognize the need to have banks as part of the solution. This is one reason why European central banks have resisted cutting rates further. We also had more announcements this week from the European Commission on a relaxation of bank capital ratios. And there's a long discussion about why this relative healthiness of banks is important. It's clearly important for bank assets, and it was, at least until today, a pretty good week for bank assets overall. But it's probably more important in thinking about the shape of the recovery. If banks are not a major blockage, then the recovery has a better chance of getting traction. And as Michelle has already pointed out, healthy banks mean this money supply surge has a better chance of making its way into the economy and becoming more inflationary. Just sticking with inflation, it was a pretty interesting week. Despite all these widespread fears of deflation, today, most CPI reports were by and large better than expectations, in some cases quite a bit so. So we've had upside surprises in core CPI in Australia, in the US, in the Euro area. And I'd say the dynamics of those surprises were broadly similar. A big surge in food price inflation in many instances, and conservative estimates of when there was no data to collect. So I would emphasize Michelle's point that clearly in the near term, the risks around inflation are down, but longer term, I think it's a fascinating question, and the risks certainly from my point of view are up. And I'll leave you with one anecdote, a New York Times article just the other day discussing the outlook for airline prices when, if we open up and we have social distancing, what does it mean in terms of capacity if you want to find a seat on a plane? And I also saw this week as an anecdote, the Japan Ministry of Finance is planning to cut its issuance of inflation-linked debt. And I do wonder whether it might regret that decision in a few months' time. Two other quick themes. So oil prices had another very volatile week, but I think behind this volatility, there's a pretty strong case for the first time to see a basing in oil prices. And I think what we're seeing is major supply cuts outside of OPEC, most notably in the US. And I don't know that these supply cuts are a sufficient condition to stabilize oil prices, but they certainly are a necessary one, and the data have been very encouraging. So I'm going to finish on the dollar, which has been quietly drifting lower over the past couple of weeks. And what I would say is that medium term, we do agree with this trend. We do think the dollar is going lower. Kind of three parts here. It came into the crisis very expensive on a long-term basis. Through the crisis, the Fed has slashed rates pretty aggressively, and the dollar's yield advantage has pretty much been fully eroded. And I think as we exit this crisis, some of the exceptionalism of the U.S. economy and U.S. asset markets aren't going to look so exceptional anymore. And one thing I'd point out in particular is the U.S. stock market, from a valuation perspective, is still still more expensive than it was even before the 2008 crisis. You can't really make that case for any other major indice out there. The only warning I'd say around dollar weakness is timing. For whatever reason, and we could debate this time and time again, the dollar does tend to rise fairly consistently in the month of May, as does foreign exchange volatility. And this dollar strength, this volatility increase, is really the mirror image of that old saying, sell in May and go away. So we'll see whether or not that works this year, but something worth thinking about. And with that, I will open it up to any questions you may have. Okay, I do have a question on the screen for Michelle. Does the money velocity relationship discussed in the US, is that applicable to the UK? And can Ross comment on what it looks like for UK RPI CPI prints? So I think that's really for Ross. Ross, do we have the same issue around velocity in the UK, and what does it mean for the outlook for UK inflation?
Yes, it's exactly the same. These sort of core money supply measures are obviously being boosted by central bank money, by base money expansion. But if you look at the money holdings of real economy players, the consumer sector, businesses, those money balances are little altered. And actually, one of the complications with money supply measures is that in times of recession, you typically see cash balances being built up for precautionary reasons, either fears that firms maybe can't access liquidity, or households want that extra buffer. So as Michelle was saying earlier, I think the better guide to this is going to be the lending data. And actually on that front, we had some early encouraging European lending data, ECB lending data this week, showing a pickup. It's not dramatic yet, but these are data for March. A pickup in lending to the corporate sector. So early signs, as you were saying earlier, that the policy response, at least in terms of the first stage, is working. Where do we go eventually? Will all of this central bank policy easing ultimately create inflation? Well, it could do if policy settings remain excessively loose for too long. And certainly also, as you were saying, in the context of FS, I think the forecasting side of this is going to get more difficult, because relative price changes are going to become much more divergent, much more marked. So you might see, for example, big falls in airfare tickets over the next 6 to 12 months, but then maybe subsequently much bigger rises. Overall, if you're building a medium-term inflation model, at some point there is an output gap, a supply and demand gauge that you have to include in some way. And again, I think this is where things are going to get more complicated, because as Michelle was mentioning earlier, if investment spending is weaker, if the supply side, if there's lasting damage to the supply side, that would be giving you an inflationary signal. But against that, if we have higher, stickier unemployment, those labor market gauges of capacity are going to be pushing in the other direction. So all of this is, I guess, a slightly long-winded way of saying, in the short term, the next 12 to 18 months, I think we're relatively confident that there will be disinflationary pressures. Maybe not, certainly in, say, the case of the UK and the US, I don't think we're going to see persistent negative inflation. As you say, food prices have been rising and so on. Medium term, it's more ambiguous. And ultimately, the inflation we end up with will be determined by central banks and policy settings. But the forecasting process and around these output and capacity concepts, the supply side damage, that's where it's going to get more tricky.
We have any raised hands because I wanted to continue. Okay, here we go. What is the downside risk to our bearish view on rates? We've been calling on them to rise, but many issuers are not convinced. So I'm assuming bearish view on rates means the view that we think that yields are moving higher. Obviously there's any number of risks to that, but I think the biggest risk to being bearish on rates right now is simply, we and most of the world are wrong about the potential for recovery. If we're sitting in shutdowns like we have today we talked about this on the last call, let's say 3, 4, 5, maybe 6 months, then it's not a linear outcome. The risks become greater and greater. That's going to be very hard to start the economy back up. But what I will say, I've said this before, given the level of stress in the global economy, the actual performance of global rates markets, I think for anyone looking for more bullishness has been pretty disappointing. Rates as macro hedges have not been working particularly well. I wanted to just go back to the labor market discussion. I think this is both for Michelle and Ross. So we've talked about this as a group quite a lot about the different labor market structures. And we've seen some reports coming out finally on labor market performance into the crisis. The Asia numbers have been super encouraging, but you rarely get increases in unemployment in Asia. But Ross, so Europe, we've got a few numbers. What's your take? What's your take on the chart we saw from the IMF and the expectation for the UK? And then Michelle, maybe you can finish up on what we should expect for next week's ever important US payroll report.
Yeah, so the IMF mid-April published updated forecasts, and the most interesting thing I thought macroeconomically was the huge divergence in unemployment rates and the change in unemployment rates. And this is partly a function of underlying labor market flexibility, but principally it reflects some of the emergency policy measures that have been put in place. So just at a headline level, the IMF is looking for really a pretty dramatic rise in US unemployment, rising to above 10% next year. By contrast, the UK on the IMF's forecasts, published unemployment rates, they think will be just below 5%. Now, the bulk of that is because the UK has this job retention scheme where workers, instead of being made unemployed, are furloughed, sort of press the pause button, if you like, and will eventually come back into the labour market. They're still formally in employment. And numbers we had from the UK Chancellor this week, that job retention scheme, there are already 4 million employees signed up to that scheme. Now, not all of that 4 million would have been unemployed in the absence of the scheme, but clearly, plausibly 1 million could have been, possibly 1.5 or even 2 million. And if 1.5 million, there were an additional 1.5 million UK unemployed, we would very quickly see the UK unemployment rate going from around 4 to 8%. So I guess one of the things we'll need to sort of try to look at, particularly from a forecasting perspective and trying to work out how quickly consumer demand recovers, is, what's the real position in the labor market? I mean, a lot of the unemployment that we'll see in the US, for example, will probably be temporary. But one of the just final point on this, the worrying features of the IMF projections, and they are just forecasts, but they seem to expect these high unemployment rates to persist in most economies. And that would be a factor holding back demand if that were to happen.
And Michelle, next week's payroll data.
So as I alluded to, we came into our initial forecast had been for a payroll drop of somewhere, in excess of 24 million. And some of the unemployment statistics that we've seen, with the claims numbers suggest that it might be somewhat less than that. I think, again, so maybe it's closer, let's say 18 million, and the increase in the unemployment rate is more like 12 to 15% as opposed to 15 to 20%. But stepping back, when we think about different policy approaches in the U.S., while we have seen the payroll protection program, which was expanded, the intent there was to keep workers connected to their employers, encouraging firms not to lay workers off. At the same time, a big part of the stimulus or relief that's been offered was a sizable increase in unemployment compensation. And so not only were a broader number of individuals made eligible for unemployment, but also the amount of money, a $600 per week federal payment on top of what is the benefit that's paid at this. And I think we may have talked about the fact that in the U.S., perhaps as many as 50% of workers who have been unemployed will end up making more because of this additional federal benefit that's being paid. They'll end up making more in terms of unemployment benefits than they had been making when they were working. And actually that has encouraged firms to lay off workers because workers can earn more through unemployment benefits than the companies are paying them at this very difficult time. So we have had that disconnect, and it does get back to the underlying dynamics. As Ross said, I mean, we're looking at this big jump in the unemployment rate. Will be very important and interesting to see to what degree that those unemployed are viewed as temporary. We talked about the fact that a good portion of the increase in March in unemployed were those who said they expected to be back at work within 6 months. And looking historically, when you see an unemployment rate jump, but the jump being driven by a high percentage of temporary workers, you tend to see a pretty quick reversal in that unemployment rate spike. We saw that in the 1970s and early 1980s recession. So when we look ahead to next Friday, in addition to what that headline grabbing unemployment rate will be, the underlying dynamics in terms of how many workers believe that increase in unemployment is going to be temporary, could have important implications, as Ross said, ultimately for the longer term impact on consumer demand and behavior.
All right, thanks, Michelle. Well, I think that's all the questions that we have today. I suppose it's life in the times of coronavirus when the good news is only 18 million down in payrolls next week. So we'll see you next week as we start the fifth calendar month of this crisis. I'm sure there'll be plenty to talk about, but thanks again for calling in.